Welcome to today's Canary Report. Markets closed lower as investors executed a tactical rotation out of mega-cap tech, while speculative energy built up in mid-cap and thematic plays. The Nasdaq 100 still rallied over 2%. But the Magnificent Seven are having a dreadful year, creating divergence within the broader tech complex. Let's see what our canaries are telling us about where capital is actually flowing, versus where headlines suggest it should be going. Speculative appetite is surging today across all risk assets. ARKK gained 2.33%, SPHB jumped 1.94%, and MAGs led the pack with a 2.62% surge. The Magnificent Seven theme ETFs are showing particular strength, suggesting investors are rotating within tech rather than abandoning it entirely. This pattern mirrors last month's behavior when SPHB and XLY both posted multi-day gains as institutional money rotated out of passive megacap exposure into active thematic positions. With the Nasdaq 100 still sizzling and earnings season approaching, smart money appears to be positioning for selective exposure rather than broad beta. Credit markets are showing subtle stress signals today. HYGW fell 0.51%, while HYG and HIGH both gained modestly at 0.19% and 0.28% respectively. The divergence between investment-grade credit and high yield is narrowing, which typically precedes a rotation back towards safer fixed income, as investors anticipate potential earnings disappointments in the next week. With yields hovering around 4.37% on the 10-year Treasury, capital appears to be pricing in moderate economic softening rather than outright recession. The slight pullback in HYGW specifically suggests institutional rebalancing ahead of what could be a choppy earnings week. Volatility products are all selling off. UVX dropped 6%, VIXY fell 4.11%, and VXX shed 3.96% across the board. This compression indicates complacency is building, particularly as the VIX sits at 1765, well below its recent averages. The headline, "Global Cold Feet on AI Trade Affect Pre-Markets," likely contributed to early caution, but the broad-based decline in fear products suggests this was more tactical than fundamental. When you combine lower VIX with rising speculative ETFs, you're seeing classic risk-on behavior where traders are comfortable deploying capital. Despite underlying uncertainty about AI's long-term trajectory, the engine is showing mixed signals. SMH surged 3.71% as semiconductor demand remains resilient, while Carry dropped 0.52% and IWM barely moved at 0.3%. Industrial production, IYT, gained modestly at 0.36%, suggesting manufacturing activity is holding steady despite broader concerns about emerging long-term headwinds for the S&P 500. The Russell 2000's flat performance of 0.01% indicates small caps are neutral, neither defensive nor aggressive. This divergence within the real economy suggests selective exposure. Investors favor technology infrastructure and hardware, while remaining cautious about consumer-facing industrial sectors. Safety assets showed limited appeal today. Bond gained 0.34% and TLT moved 0.33%, indicating modest safe haven buying, but GLD fell 1.71% as gold lost its shine alongside the dollar's slight decline of 0.25%. The XLP consumer staples sector dipped 0.57%, showing defensive rotation hasn't fully materialized yet. This limited flight to quality aligns with the VIX compression. Investors aren't desperate for safety, but they're also not aggressively pursuing it. The balance suggests a transitional phase where capital is waiting for clearer directional signals before committing to either risk-on or risk-off positions. Today's market action reveals a classic rotation pattern. Institutional money is moving out of passive mega-cap tech exposure into active thematic plays and mid-cap opportunities, while keeping overall risk appetite elevated. The Magnificent Seven underperformance contrasts with the broader Nasdaq 100 strength indicating investors are selective rather than defensive. Credit markets hint at potential near-term volatility as earnings season approaches, but the compressed fear gauge suggests complacency is building. Dangerous in both directions, depending on what triggers a reaction. That's your Canary Report for today. The Canaries are singing cautiously optimistic notes, with speculative energy building alongside selective real economy exposure, but watch credit markets closely over the next few trading sessions as earnings reports begin to roll out. Stay alert to any sudden shifts in the fear-greed balance. When UVXY starts moving above 27 again, that's when we'll know the complacency has turned into something more structural.